Hello, welcome to another edition of Nucleus Investment Insights. Just going to have a relatively quick one today. Just wanted to run through a little bit what went on last year and then just talk through where we're sitting at the moment. Valuations, what are the major issues markets are looking at, where are where are we seeing in terms of stocks, and what are the types of performance figures that we should be expecting, I guess. Just to run through, I guess, the big ticket ones. I'm sorry, and also just a quick reminder, everything you hear today is it's general in nature. None of it's personal financial advice. If you do want to get some personal financial advice or talk about your own situation, book yourself in for a call with us. So I wanted to start with some of the investment factors. Now, this is one I sort of pop up from time to time, and it's what it's showing is, what are the key things? What were the investment styles that really worked from quarter to quarter over the last year? And as you'd expect, it was a pretty wild year in terms of the performance, really. So I've got the top ones are US, the bottom one's Europe. What that's showing is that whatever style factor you're interested in, from quarter to quarter, and it's just as bad and possibly worse on a month-to-month basis, is it was just chopping and changing. So so what this one is, if you just went and bought the top, so the top one, the valuation factors. So if you went and found the cheapest stocks and bought them and then sold the most expensive stocks, so you did sort of a long short on those, what would your return have been? So in the second quarter, 2025, so the most recent quarter, you would have lost 14%, but the quarter before that, you would have made 14%. So there's a sort of an almost 30% swing in performance just from quarter to quarter by buying the cheaper stocks out there. Size was similarly quite volatile. If you look over the year, this price momentum strategy, that was sort of the worst performing in the US. And what is price momentum? Well, this is the idea that you basically buy the stocks that are going up the most, and you sell the stocks that are going down. And so it's a very high trading strategy. So if you want to follow this strategy is something you got to be jumping in, jumping out of all these stocks consistently. But what it's showing there is that it's usually a relatively a better strategy than you'd think. It sounds like a very simple strategy. You just buy what's going up and sell what's going down, and sort of, I guess, effectively what technical traders are doing. But it's usually relatively successful, especially if you exclude some of the trading costs that these things do. But it was the worst strategy, and that was because we had the Trump tariffs on off again. Things were looking great. He's going to throw all this money at it. Things were looking terrible. Everyone's facing these massive tariffs. We've got wars. We've got issues in terms of migrants, and calling the army out on your own citizens, and all these whole bunch of different things that are going on in the US, and with in between the US and other countries as well. So price momentum is not the place to be, and that's because we kept on seeing all those different reversals. Everything looked great, and then everything looked terrible, and then everything's back to looking great again. Earnings quality, this is sort of one that sort of sits in our we've been certainly playing in that space a lot over this year. That was for the year, it was the second best performing sort of strategy in the US, which is why it sort of led to some of our portfolios outperforming on that basis. But it was it wasn't always the greatest. So certainly second quarter, we saw that sort of value rally, and some of and a fall on some of those stocks. And then so you go through some of the other ones. The other one that's been wildly volatile is the volatility one, and effectively that's a strategy where you just buy the lowest volatility stocks. And that had an even bigger swing around, So if you had to follow that strategy, you would have lost 25% almost in the first quarter of 2025, and then made 40% in the second quarter. So some quite significant differences, and that actually ended up being the best strategy over the whole year, but the most volatile as well. So for the sake of being slightly behind on the earnings quality, given the volatility, I think it still looks like using hindsight, looked like the best strategy to follow. That wasn't completely the same story in Europe. Well, actually, sorry, that's putting it lightly. Earnings quality was actually one of the worst strategies in Europe over the year. Europe was more about a valuation or an analyst expectation. So really looking at stocks where you're seeing the upgrades, and a lot of that comes back to a couple of charts I'll show in a minute, which is some of the defense sector that really rallied quite strongly, and stocks were seeing significant earnings upgrades within Europe were really quite powerful within that. Okay, so that's sort of like a broad scheme of it. So, I guess I'm not telling you anything, amazingly different in that, yeah, it was a wild year. Stocks were up over the course of the year, and so that sort of helped to drive performance. But it was very varied in terms of where you were getting that performance. And so I think in terms of some of our funds, international was sort of up 17% odd. Aussie funds up closer to 10, and the overall growth fund was overall growth fund, more like about more like 12% return on that overall growth fund with a pretty heavy international exposure there. So so a good year, but it's an extremely volatile year, and there's questions about where to go from here, I guess, is very much the thought. So I'll jump into some of the other factors. Currency, a huge deal particularly in the later half of it. So if you look at I've got a chart just up showing the S&P 500 in US dollars in a common currency term, and so and then the MSCI World excluding the US. And so that was so outside the US was outside the US, we saw a lot better stock performance than inside the US. And then the other factor was if you look at the S&P 500 denominated in other currencies, the performance doesn't look anywhere near as good. So yes, it fell, from Liberation Day, it fell and it's back to where it started, and higher than that. But if you look at it in yen, you're still down sort of 5 or 6%. If you look at it in pounds, you're still down about 10. If you look at it in gold or euros or Swiss francs, you're down more than 10% still. Just because a lot of that currency changes, that really does affect performance for international stocks. The other thing is I spoke a little bit about the defense sector. So that was a real boom in terms of Europe for arms manufacturers, and sort of this is sort of coming from John Authors runs a few of these, but he's one of these ones was that the two trades. Trump theoretically was all about America first, and it was about helping the car makers and putting on these tariffs to sort of help, steel makers and car makers, and trying to help them out. But actually, if you look at a performance of buying the European defense and selling and shorting versus buying the US auto sector, you're sort of 200%, or you basically doubled your money by going long the European defense and short US autos. So yes, it hasn't been a good trade for a number of the things that I guess Trump purports to be trying to help out. So autos was one. Another one, this is one we certainly were a fair bit on this trade as well, is that if you went long the clean energy stocks and short the energy sector, that you ended up well in front in terms of that trade. So particularly the oil and gas drilling stocks within that. So one of those that's a trade we're sort of still in and feel that's actually. A lot of those clean energy stocks really got smashed right at the start of the once Trump won the election, and we very much used that as an opportunity to get in. and still think there's a reasonable amount of potential for those ones. They're not particularly expensive, and if you take the view that look, the wind is not shining, is not blowing in their favour at the moment, but at some stage it will. If you can buy these stocks at reasonable prices, and you're not going to lose too much money. Sorry, they're still making lots of money and got reasonable earnings growth even with quite a negative environment. And if at some point the political winds flip back the other way, then there's some significant profits to be made within that still. If you look at valuations on the valuation front, so there's this actually I've got so we're sitting at I've got some of the global numbers over here. We're back to the highs that we were in recent times. So if you go ex financials and resources, that's sort of my favorite measure for that, is we're back to 21 times or 22 times just about, which is basically where we were not that long ago, and sort of similar levels to where the markets hit sort of post-pandemic. And that is about at the sort of pretty close to the 90th percentile in terms of it, in terms of where it sits. Australia is a lot more expensive than that. Australia hasn't actually reached back to its sort of the pandemic heights, but it is above sort of some of its more recent heights, and trading, sort of 10% above that again for Australia. So that we've got less sort of confidence over that the Australian one that certainly looks. I haven't got a huge amount of faith in terms of why Australia looks so much better. Partly that's, if you break that down a little bit more, and you said, where's Australia sit sort of ex-banking and resources? We're not that far above. We're sort of maybe 5% above the average, and sitting at the sort of the 50th or 60th percentile in terms of ranges. So on a basis where you exclude the banks and resources, Australia, the rest of the Australian industrials don't look that expensive. Australian resources don't look that expensive relative to world resources, but the Aussie banks are very much up there. They're sort of almost twice as expensive as an international bank, and at its 99th percentile or something like that in terms of the Aussie banks. So, and a lot of that's Commonwealth Bank. So there's a lot priced in to Aussie banks. So valuations for Australia, not particularly good, and most of that is because of the banking side. If you have a quick run through some of the other countries, you can some of the other big sectors of the world. So Europe certainly has come back in terms of valuations, like that run up in prices we saw over the last couple of months for European stocks has sort of brought it back a little bit more into focus. But it's still sitting at the 10th percentile or below the 10th percentile in terms of its usual valuations relative to the rest of the world. And a lot of that is sort of the American exceptionalism still in terms of being expensive. And then Japan, very similar, sitting below the 10th percentile. Looks cheap relative to the rest of the world. So for us, that's sort of largely how our portfolios are still positioned in that we've got more more Japan, more Europe than what we do US, but within the US we're quite we think there's lots of opportunities for some of the better stocks in that. So you're sort of looking for Europe. We're looking at the US in terms of some of the growth stocks and some of the ones we think that the highest quality ones where we think there's still scope for those to grow, even in sort of poorer environments over that time. Let's have a valuation side. I might just go to a quick message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Well, right. Okay, so I've got a few questions here, which I will get to. But what I wanted to do first was just sort of run through what some of the outlook, some of the other outlooks, some of the fundamentals behind it. So we've spoken about valuations; they're high. High valuations aren't always bad. Quite often, the market actually performs relatively well from high valuations, as long as you see growth. That's the number one factor, because if growth flips, then what you end up finding is the high valuations go to lower valuations, and you get sort of both. Let's say you're talking about your valuation on top, the price of the market divided by the earnings or cash flows or whatever number you're using on the bottom. Is that if that number on the bottom starts to fall, and then the overall multiple that the market's prepared to pay starts to fall, you get that double whammy on the downside. So the first quarter of the year, we did see some reasonable earnings downgrades. But that's sort of come to the next quarter or so. The next quarter, especially the second quarter, has been pretty reasonable. Like I'm just showing a chart of the forward earnings, and that's the red line is the line that's sort of important in this one, which is the your 12-month forward numbers. So basically, if you keep this sort of constant sort of forward and always looking at 12 months. So at the moment, we're taking half of the 2025 numbers and half of the 2026 numbers. What do you get in terms of the that forward outlook? And as long as that line is rising, things are usually pretty good. So we can see that on this one, that line fell from sort of mid 2022 to mid 2023 or early 2023, and that's coincided very much with that reasonable downturn in the market. But the growth's been pretty good. We saw a bit of a tip down at the sort of start of the second quarter. Now that we saw this sort of a wave of downgrades, but that red line's since has started rising again. And the key part is really that you can have downgrades in 2026 numbers, but as long as they're not too severe, then that red line's still rising. So we're still getting that's the growth from 2025 to 2026 is still looking at that sort of 10% plus in terms of those numbers. Not to say analysts don't get it wrong; they do, and particularly at turning points. But what we're hearing from companies is generally that they think things aren't too bad. There's sort of they'll complain. There are a whole bunch of complaints, but particularly for big companies, their ability to shift costs around and they've got I think they do have generally a much better control of their supply chain than what they had sort of pre-pandemic and before they sort of went through all these supply chain issues. Is that there is scope to sort of go, well, we think prices are going to go up by 5%, and costs are going to go up by 5% for anyone who's whatever importing from countries that are most affected. But a lot of companies are going, well, we can shift our supply chains around, and we think our costs might only increase 3%. And so they're sort of looking at it saying, well, if we can put costs up by 5 and only if we can put sales up by 5 and only increase our cost by 3, we're actually improving our margins. And so what they're losing in terms of a weaker US economy, they think they're making up in margins. So we'll see if that actually comes through. But at the moment, it looks the analyst forecasts all look pretty good. If you break that down to sort of quarter by quarter numbers, you basically got the same feel for that. The first quarter was already in the bag. Second quarter is going to start reporting. Companies are reporting that starting over the next month. So we haven't seen massive downgrades so far, which usually if you were going to see downgrades, we would have started to see them by now. And third quarter and fourth quarter are still looking relatively strong. In terms of growth rates, they are looking at, we sort of flip that back around and just put it in terms of numbers. Second quarter looks like it's coming in around about 4% growth. And then the third quarter and fourth quarter are looking at 6 and 7% growth. So certainly not blowing you away in terms of the numbers, but if you can pick up a 2% yield and get 6% growth, that's an 8% return for you in terms of overall. It's that's not a bad outcome and sort of what you'd expect over the longer term in the stock market. So as long as we don't see disaster in those numbers, that sort of gives you some support for the stock markets. So that's the earnings forecasts. If you look at just some other forecasts, the other big ones I think that's worth keeping an eye on, particularly as is the big beautiful bill bounces back and forth and looks like whether that comes off or doesn't come off or where that sits, I think it will be relatively important. Is we're looking there at how much government, sorry, what the split is in terms of government spending versus receipts. And despite I guess the news around Doge and what their plans were in terms of cuts and what they were going to do, the reality is that they're not, and that US spending still looks very, very strong from governments. And you can, for us, we largely think about the economy as being three different parts of it. Well, four in a way, if you're talking about an individual country, but you're sort of talking about your government sector, your household sector, and then your businesses. And if your government is out there spending more than what it's bringing in, then that means there's money flowing to one of the other two sectors. And the household sector has been picking up a bit of it, but the businesses sector is usually the best at taking government, capturing deficits and turning that into their sales and their profits. And you can add another sort of external sector to that, but I think the point I guess I'm making is if we're not seeing large cuts in budgets, then that's generally going to be good for corporates. Then if you talk about the yes. So let me go to one more quick message. Then I want to I'll hit some of the questions, and then I want to talk about the outlook from from a conceptual point of view and how we're looking at what can go wrong, because I think that's probably the big thing for certainly the next 6 months.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So let me hit a few of the questions first, and then I want to jump in and talk about the overall investment outlook for the next year. Max got a lot of questions about Canberra property. Look, I've actually got property one coming up. I'm going to save, and I must admit I haven't looked in detail at property, Canberra property in particular, but we have we sort of have a bit of a house view that, look, falling interest rates is probably going to be a good thing for most property sectors around Australia. Negative thing for Australian productivity, but good for Australian property, and we'll dig more into that in terms of future episode. Some questions about Chinese stocks. Look, China was pretty good over the year. They were sort of up about 14%. China's a weird market to invest in. If you're investing in China, the biggest advice I'd give is don't just buy a Chinese index, because if you just buy a Chinese index, what you're effectively getting is a really large chunk of state-owned entities. And these are the companies that are not really run for profit. They're run to keep people employed. Chinese government owns a lot of them. They're there to help implement Chinese policy as well. You probably want to go to somebody who's actually picking the stocks within that, and they're picking up stocks that are things like your Tencents or your Beidus and Alibaba, or stocks that they where the fundamental views are good, BYD or something like that, where they've got a view on the company and they're buying at the right price and all those types of things. If you buy a very generic Chinese stock exchange, one, you're exposed very much to these state-owned entities, and then secondly, the there are other things going on within the Chinese market that whether the Chinese government is encouraging or discouraging investment can make a big difference in terms of the performances you get there. But yeah, it's one you can choose as a tilt within our portfolios. So we run these core portfolios within ours. You can choose to stick to Chinese exposure, but we don't naturally put Chinese or any emerging markets into our portfolios as a standard. Where are we looking at? Okay, I think the other ones I wanted to run through then is in big picture terms. What can go wrong in terms of markets. So I think where we see the US is sort of starting from really quite a strong position. They've got a strong US economy that has sort of defied a whole bunch of things over the last few years that people thought would knock it off kilter. It's got all these big productivity gains that have been coming through. There's some things in terms of the weight loss drugs have sort of flattened out. The amount of obesity that's coming through. So the obesity rates have stopped rising in the US. You've got driverless cars picking up stuff all the time. You've got AI. There's a lot of stuff behind sort of the scenes in the US that look quite good for the whole productivity gains. Then you've got the whole chaos of what's going on in terms of Trump's ones, and in particular, this week we'll see. Well, we've got this big, beautiful bill coming, and then we've got another. Over the next week, we've got a whole bunch of deadlines for various tariffs, and they're on top of that. You're looking at so from a big picture sense, we're looking at big deficits, so lots of money flowing to corporate sectors. You're looking at Fed that's probably disposed to be cutting rates rather than raising rates. There's quite, there's a few question marks about whether you'll get a Fed chair in another year's time or maybe there'll be a shadow one appointed earlier that will really talk the market about having lower interest rates. And so there's this idea that you're taking like an economy that's sort of not too bad and you're throwing extra debt and more tax cuts and lower interest rates and, trying to build this up into a boom, with disregarding what any negatives that might come from a bust later on, which is a strong possibility. So that's sort of the overall part, and then you go like, so as long as something doesn't go wrong, you can actually see a relatively positive outcome from a corporate perspective and from a market's perspective. The problem is all the things that can go wrong. So let's talk about the trade deals. And there's positives and negatives here. Look, our take was that they wouldn't have the trade deals, weren't going to get done, but you're going to see a whole bunch of announcements, and the announcements are going to be constant in terms of we've already seen China, all these. Oh, we've done a deal with China. The deal's on, the deal's off again. We've done another deal with China. We've done another deal with China, and really in the end, what they're announcing is that. Is really actually not an actual deal, but there's like, oh, we've agreed to stop torpedoing each other, and it's being hailed as a trade deal, or and you're going to see that China's probably got another 20 or 30 announcements to make about, oh, we've done another trade deal with China. There's on the negative side, Japan's sort of staring down the US at the moment. They look like they're backing off in terms of Canada, but I guess what I'm coming from the trade deals perspective is it looks like he could really stuff things up if he goes back to some of these really high ones. But on the flip side, there's probably just going to be a steady stream of announcements. Yes, we've done a deal with somebody where they're actually not really doing deals. It's sort of like a heads of agreement or a rough, some sort of rough plan, but it'll be trumpeted as this major trade deal and major breakthrough. So sentiment positive, sentiment negative, probably more sentiment positive. There's problems with the inventory cycle. The whole tariffs are on, they're off again. We're hitting the end of the 90 days. Are they back on? Are they back off? There's going to be all these different issues in terms of that inventory cycle, whether we see it's going to be overstated. It was overstated for the first quarter. It's probably going to be understated a little bit this quarter, and going forward, it's going to be overstated again because there's this huge flood. And then at some point, it'll go back to something more normal. So that could upset things, but it's certainly it's going to be confusing what's going on there. This whole capex hold up in the US, all this uncertainty has meant there's been lots of capex on hold. Is that enough to throw the economy off kilter or not? hard to tell. There's certainly a big switch between small companies and large companies that we're increasingly seeing within the US. That's something to throw it off kilter, but it's probably more likely to be positive for the stock market. Inflation in the US is going to be hotly watched, let's say the least. I think we're probably going to see a mix of, we're sort of looking at it going, well, China is rapidly exporting deflation as much as it can. You're not going to see some of that because of the tariffs, but then there's probably a little bit of extra US consumption, so a little bit of lessening in US consumption that might offset some of the inflation that we're seeing as well. Then you got the whole factors with worker shortages, higher US wages as you have these worker shortages. There's a bit of, within the workers, there's undocumented versus documented. So if you have a big fall in the undocumented, but a small rise in the documented workers, that might make it look like the market's better than it really is. There's a purging of US institutions going on. There's issues with getting rid of some financial regulators and stuff like that, which is probably a good thing in the short term as that comes through. But at some point that could blow up in your face. It's quite possibly going to be a few years down the track, but maybe it comes sooner. And then there's this whole taco trade reflexivity about everyone says Trump's going to back it. Trump always chickens out, and he's going to back down. Maybe at some point the market's pricing in that he will back down, and Trump, for his own purposes, decides that he wants to follow through. And so, I've got a list of about 15 or 20 things, and I've spoken about it in some of the other podcasts that we think can throw the US market off. But absent that happening, it's sort of we're in this position where it's like it's hard not to be invested. And so, so that's where we're basically sitting. Is from our perspective is, cautiously invested, bit of extra cash in case we see some downturns and where we're going to throw it into. Very much looking for quality companies over value or growth. Is that the idea is for us as well? If there is a boom, growth companies are going to do better, but if there's a bust, they're going to get smashed harder. So let's sort of limit some of our upside by just going with these higher quality companies, which will still perform well if in a good environment, but really work on limiting that downside if we do step on one of these landmines, economically. We're still sticking with the where we can overweight Europe and Japan. Within particular sectors, being quite specific about the ones we want, and then still looking for some of that growth stuff coming out of some of the bigger companies within the US. So it's a as confusing environment as we've seen in a very long time. I think we're cautiously invested. We have a reasonable amount of cash that worked quite well for us over the last year. And we're just sort of trying to weigh up what the outcomes can be over the next year, and really trying to avoid the big blow-ups. We think is probably going to be the key to 2026. With that, I think that's got most of the questions. Apologies for anyone whose questions we didn't get to, but thanks for listening in. We are on all the different major podcast platforms. You can get us live on YouTube on Thursdays at 12:30. You can grab us on social media. We've recently put out some changes to some of our websites. So if you haven't been there, you can jump on there and register for to get sent out our podcasts and our posts. And we've got a number of new content posts that will be coming up over the next week. So look forward to sending those through and mailing those out. Otherwise, we'll see everyone next week. Thanks for tuning in.